downside momentum in the quantity. So it is easy to say that even if market is going in the uptrend, but because of the volume is not as supporting as the trend, so definitely there can be the expectation of the reversal, and which we can see at this point. After a particular momentum on the upside, we can see it going down. It is going down. Finally, if we see in the another example at this point, we can see same kind of bullishness, and which is going for a while. But after a certain point of time, if we see the volume, it is going just opposite of the existing trend. So we can see even if the market is into the bullish trend, but volume is not exactly trading in the simultaneous mode of the existing trend. So definitely that is going to be a reversal. Now I would again say that we can't use this particular indicator just for the only as a single indicator. We have to use this along with different indicators like MACD or RSI. So we will discuss these all, how we can use them. Okay, so we'll move to gaps now. So what exactly is the gap? We will directly go by the example. Like in this current chart, you can see in the left hand side there was a downside momentum earlier. After a sudden small spike, market gave a gap. You can see my mouse pointer. So this much size is the gap size, which we say as the market opened with a different price as compared to earlier price. So now the point is, what is the use of gap? If you see our analysis, then as per the analysis we can understand one thing, that after showing a gap in a particular direction, if market reverse, and that reversal should be opposite of the past trend. So here market was in the bearish trend, market opened with a gap, and after that there was a slight reversal, and this reversal breached this particular trend, and you can see this black line across, and this trend is breaching the previous gap. It is recovering that, and after that you can see that market is going completely into uptrend. So in layman language, simply we can understand that if any pair or any commodity has given a gap, and after that there is a opposite or reversal direction momentum in the currency or commodity, and if there is a recovery of previous gap, then definitely there would be a sharp momentum in the long term. Now, as I have discussed that we will be using different indicator at the same time, you can see downside where is a MACD plotted. Just nearby my pointer you can see that this red line, which is the MACD line, reaching this 0 line. So it is giving an indication, or it is supporting the existing momentum given by gap. So we can see there is a upward trend in the gap along with the MACD support. So what exactly MACD is used, we will discuss it later. So now we will see another example of gap. Pattern is more or less the same, just there is a change in the direction. You can see that at this point of time market was slightly into uptrend in the consolidation phase. Market closed at this point somewhere, and it opened with a particular gap, and that was a sufficient gap. Again it tried to recover, and it exactly breached the level where it opened in the gap. So we can see that if market is recovering after a gap in the another direction or opposite direction, then possibly the outcome would be a sharp momentum in the downside. We can see that this particular trend is going into bearish trend, and which is the just opposite of the existing trend. The same thing we can see in MACD. Like at this point of time you can see that MACD histogram was trading into negative zone. MACD line is also going into negative side, so it is giving a supporting idea that market is going into bearish tone. Now there was a case just around say 5 to 6 months back of Russian ruble case. So what exactly happened, there was a sharp fall into oil market. We can see that currently it is trading somewhere at 50, around 52, 53, but earlier it went down till 41. So when market suddenly breached 50 levels in crude or say US oil WTI index, after that there was a, one second, sorry please, once again. Yeah, so you can see in this chart somewhere at my pointer that market was going into uptrend. It was say time of January 1st, and suddenly when market of oil market breached 50 level, Russian ruble opened with a downside gap. You can see this point. It closed at this level, but because of due some external factors, it closed. After closing, it started opening at this level. And just after few candles, you can see that market recovered the existing trend, and it also given a breach at this point of time. So we can see that after a particular gap and recover, market is trading into the upward momentum. And that thing also can be noticed in the MACD. In the downside, you can see that MACD has breached this particular zero line and is giving some bullish signals. Now, it's not the kind of prediction that whenever there is a gap, there would be a recover or there would be a reversal in the existing trend. You can see in our first example in the left hand side, there was a good gap, sound amount of gap. You can see in the GBP USD, market closed at this level and it opened at this level after that. But just after a few point of recovery, it could not sustain or it could not breach the gap starting level or gap starting point. So we can see that market moved in the same pattern. There was not any reversal at all. And if we see MACD, so you can see there is no any divergence in the MACD in the downside, where my pointer you can see it was moving in the same upward momentum. So there was no any trend reversal kind of indication in the MACD. And that same thing can be noticed in right hand side example, where you can see that market was going into uptrend and it opened with some sound quantity of gap, but it tried to recover, but it was not able to succeed. So ultimately the trend remained the same, and that same thing can be seen in MACD as well. In the downside, you can see that market or MACD indicator is going as the same way it was earlier. So we will move to next indicator, that is head and shoulder. Head and shoulder is one of the crucial pattern which you can find either into technical, say in daily chart, in monthly chart, in hourly chart, or what kind of chart you follow. So you can use this as a reversal pattern. Whenever you have to find a reversal, you can use head and shoulder or inverted head and shoulder. So we will see first of all head and shoulder. This is the left chart you can see. So this is just a rough idea about the projection, about the pattern. You can see that the particular pair was moving in the uptrend. It created a left shoulder somewhere at this point. It came down. Again it gave a spike which was above the left shoulder. Now after giving a spike in somewhere, as we can see written as head, it again came down and created a similar low somewhere around the left shoulder. You can see this point, and after that again it came up, and the spike which is given later on is the same as the left shoulder. So there is a pattern of kind of two shoulders, one is the left, one is the right, and head in the between. And after that, if there is a reversal or say there is a breach on the downside, which is the neckline here, you can see this part is the neckline which is formed by the bottom of two shoulders, right and left. So when this market or this trend is breaching the neckline, there would be a sharp reversal. Now the point is, if there is reversal, how much we should be target there, like what should be the amount of target we should look ahead. So that can be seen in the left hand side. You see that head and neckline, you can see the distance between the head and neckline, that same can be extended towards our target. So same amount of fluctuation can be seen after the breaching level. And if we see inverted head and shoulder, that is also in the right hand side. We can see that there is a left shoulder, there is a right shoulder, a head kind of shape, and there is a breach. So this is a reversal point. Now we will see the live example. So you can see in this chart, initially market was into bearish tone. It gave a spike somewhere at this point, and after creating a left shoulder it came down. Again it went up and that created the top which is higher than the previous one. So it created head somewhere at this point, and again it came down and created a right hand shoulder after a sudden spike. Now the point is, after breaching this particular neckline which is formed by the left and right hand side shoulders, we can see that after breaching this level, market has traded in the bearish zone. Earlier you can see it was slightly uptrend, but after the reversal which we have noticed in the left hand shoulder, in the head and shoulder, it is going in downtrend, so which is the reversal. That same pattern can be seen into the inverted head and shoulder. You can see the chart USD JPY here. So there was a downtrend. It created a bottom somewhere at this point, created a left shoulder, again went up, and after creating a somewhere top, it gave another bottom which was the below the left shoulder. Again it created a right hand shoulder and it formed an inverted head and shoulder, and there is a neckline. You can see this black one line, and after breaching this particular line you can see that there is a complete uptrend momentum which is just the against of the existing trend. You can see in the left hand side it was the bearish tone, but after the reversal, after the breaching, it went into uptrend. Now we will discuss next is MACD and Bollinger Band. MACD is the one of the supporting indicator which you can use with each and every single indicator. So what exactly is MACD? So MACD line, if you see the chart below, this green line is MACD line. MACD line is the difference between the 12 and 26 days exponential moving average. In simple language, if I try to make it understand, so if you plot 12 days exponential moving average line, and if you plot a 26 days exponential moving average line on a chart, and you try to find out a difference between that and create a line over there, so that would be the MACD line. Okay, so what exactly MACD line is? MACD line is the difference between the 12 and 26 days EMA, and it also expresses relationship between two moving averages. Like you can see that there are two lines, one is green line and one is blue line. So blue line is the indication line, first line is green line which is MACD line. So we will see that how MACD is formed and what are the different function and areas there. You can see that there is written as bullish zone in the upper side. Upper part of this line is called as bullish zone, and the lower part below this line is called as the bearish zone. This particular line which is formed just in the between is the zero line, and this red area which you can see in a kind of bar diagram or say histogram, this is the another indication which you can use into MACD, because it moves along with the MACD line. You can see that when market started, or say our MACD line started going down, when it breached this signal line, at the same point of time MACD histogram also came into the bearish zone. So that's all the basic of the MACD. Now we will see some example of charts. First of all, there is a gold chart. You can see there are few rules which you can apply into MACD. First one is, if there is a positive crossover, you can take a buy position. In the first line where you can see this particular point, there is a breach when MACD line is crossing this signal line, and at same time we can notice a reversal or say change in the momentum. It was the downtrend, and after that you can see it went in the, for some time even, uptrend. So whenever there is a positive crossover, when MACD is breaching the signal line, there is a possibility of the reversal. Now you can see the second same example. Momentum is just the reverse of the back, the last one we studied. You can see at this point there was a negative crossover when MACD line is breaching from the top the signal line, and the same time we can see that market started moving in the downward momentum. So when there is a positive crossover, you can take buy position. When there is a negative crossover, like in the second one, you can take sell position. Now, another important evidence you can see, like whenever this MACD line is breaching this particular zero line, which is just in between of the MACD, so that gives a clear-cut indication of the reversal. Positive or negative crossover definitely gives you idea about the change in the momentum, but a breach of zero line by the MACD line is the complete reversal of the long-term trend. So you can see that when at this point, you can see my mouse pointer of the third line, when MACD line breached this particular zero line, market for some time gave a spike, but after that you can see there was a sufficient reversal or say downside momentum. Now another theory we will understand, that is called as divergence. You can see that in this particular patch in the left hand side, market was trading in the uptrend, but at the same time if you see the MACD, it is going against the existing trend. Market is into uptrend, but MACD line is into downtrend. So whenever there is situation opposite which are negating each other, and then definitely there is the reversal. That same can be seen in this example in the right hand side. We can see that market was in the downside, but at the same time we can see that below at this point we can see market MACD is moving in the uptrend, so which is the opposite of the chart. So possibly there is the chances of reversal, and we can observe that after this point of time there is an uptrend in the chart. So when MACD line or MACD pattern is going against the chart or trend, then there are possibilities of reversal, which can be our second rule. Now we will understand what Bollinger Band is. Bollinger Band is, we can say that it is slightly difficult as compared to MACD and RSI, which we have studied earlier. There are three parts in the Bollinger Band. One is upper band, lower band, and middle line. We will see later on what are these. And if we talk about the strategies, there are three kind of strategies which you can use. One is consolidation phase, second is constriction phase, and third one is the double top or double bottom. So consolidation phase is when market is moving into a range bound pattern. So whenever your market is touching the upper band, you sell, or whenever market is touching the downside, you buy. That is the position which we can take. We will go into the real time example, what exactly we can use. You can see here chart Bollinger Band. This is the consolidation phase. You can see that at this point of time in the left hand side where my pointer is, till this point there was a complete range bound pattern. Whenever market is touching this lower band, so this is lower band, this is upper band, and this is the mid band. Whenever market is touching the lower band, there are chances of reversal, which you can see after touching this point market went up. When again it is touching the upper band, market is going in the reverse direction. You can see that in long term it tried to come down, and that same thing we can see many times. And this one indicator, or say this particular strategy, consolidation phase, we have to take care one thing, that if there is no consolidation, if there is no range bound pattern in a particular commodity or currency, in that case you will not use this constriction or consolidation phase strategy, because this can be applied only when market is consolidation phase. So you can see my arrows in the left hand side. This is the first arrow, second, third. Whenever trend is touching the lower or upper band, there is a possibilities of reversal of the previous trend. Now we will see another example. You can see a consolidation somewhere at this point in the left hand side. After a particular consolidation, upper band and lower band both moved into different direction and with a very sharp momentum. So whenever there is such kind of events, when upper band and lower band both are moving into different directions and market or say trend is going into a particular direction with one-sided momentum, you can definitely take buying or selling position as per the candles are moving towards one band. In this example, you can see in the second one where my pointer is, when market was into consolidation phase, but after a certain point of time there was a sudden moment in upper band and along with that in lower band as well, and candles started moving upside, so we can take buying position at this point. Now the point is, maybe you started taking buying position at this point of time, but how to decide that when you have to exit the market? That thing can be done with the help of RSI or MACD, which you take as a supporting indicators. So in the RSI you can see mid of the RSI line where my pointer is, market was into the uptrend, but RSI line is going flat. Either it is going flat or it is moving in the downward direction, which is just opposite of the previous or say existing trend. So after entering into buying position at this point, you can see that market is reversing just because of RSI reversal. So next example, in the same you can see there was a range bound pattern, and after that both upper and lower band moved in a different direction, and candles started moving in the uptrend. So you can take buying position again at this point of time. And how to exit? You can take example of RSI or MACD at the same time. Like in this particular case, you can see that momentum of the candles was very sharp as compared to RSI momentum. So we can see that if there is a slightly change in the RSI pattern, we can take or we can exit our positions there. Okay. Now there is a real-time case which I have found somewhere. Just few months or say 1 month back only, there was a decision by Swiss Bank. Swiss Bank, like earlier, had fixed up Swiss currency against euro at 1.2 level, and just suddenly in a international meeting they removed that cap, and at that same time you can see that was the time of 15th Jan around. Market was moving in a particular range bound pattern and everything was packed, and suddenly when financial policy took place, market went into the down move. So now the point is, maybe you are not following the whole fundamental news, but with the help of technical analysis or with the help of Bollinger Band, you may think at this point of time that if there is a complete divergence in the upper band and lower band, then definitely there can be a sharp momentum, and after that you can see that complete trend went into the bearish tone. It happened just 1 month back, and at the same time you can see that RSI has also given a downside momentum, so which is also supporting the Bollinger Band strategy. Now we will see the another third one strategy, which is double top or double bottom. So as the name suggests, whenever there are two tops at the same time is the double top, and when there are two bottoms, you can see in our first example, on first white color candle or say white color pointer, you can see that market or trend touched the lower band. It tried to move slightly upside, but again it touched the lower band. So we can see two bottom at the same time or just nearby in the lower band, and after that there was a breach of this particular pattern or say this particular patch. After breaching this particular range, you can see that it was a sharp moment for a while. So whenever there is a formation like double bottom and a breach of the patch, you can notice a small reversal of the existing trend. Just like in the second example, you can see there was a bottom at this point of time where my pointer is. Second, you can see that this point it created double bottom, and after that it breached this particular patch. Now again there is a sharp sudden spike. So this is the double bottom theory, and if we talk about the double top, you can see that market somewhere not exactly touched, but it tried to touch this upper band. It came down and again went up and created a double top formation at this point. You can see that one top is there, one top is here. So after creating a double top, it slightly came down and breached this particular patch, which you can see, and after that there was a sharp fall. So this is the double top or double bottom theory. So that's all about our strategies. Now the point is, these all studies are done by individuals, so definitely whenever you will apply your methods, you will have your own strategies. So that's all for the day. If any question is there, would be most welcomed. Please ask. If you have any question, you can write down in the chat box, or you can raise a question. I will come to know and we will try to think over that. Take your time. Yes, Sneha. Hello, Sneha. Yeah, please ask your question.
Hello.
Yeah.
Can you explain me about the Bollinger bands you just told before?
Exactly which pattern you asking for? 1 second, let me go back.
Yeah.
We have discussed 3 strategies in Bollinger Band.
Yeah, this one.
Okay, 1 second. You talking about constriction?
Yeah.
Okay. So exactly what is the situation here? You can see that in the left hand side there was a consolidation phase slightly, and after a slight consolidation, upper band and lower band both moved into a different opposite direction. So whenever there is a position when market was moving into a particular range bound pattern, but suddenly there is a divergence in the upper band and the lower band. So at that time you can go with your candles. Like in this case you can see that candles are moving in the downside. So as per the strategy you can take selling position at this point of time, and you can see that market has moved sufficiently down after that. That same can be seen in this example. Market was moving into a complete consolidation phase or say range bound, but just due to some reasons upper band and lower band suddenly moved into different opposite directions, and market or say our candles moved into the upside or say along with the uptrend. So you can take buying position at this point. And second thing which I discussed is the exit point, how to decide to exit. So suppose in the first case you had taken some selling calls at this point of time, but how you will come to know that at this point I have to exit? Now after looking at this chart it is very easy to explain, but with the help of RSI you can judge that point slightly. You can see that even if the chart or the trend was in the downtrend, but the RSI was going flat. So exactly there was you can say that there was a lack of strength in the RSI. So it started moving up. So I hope some things would be clear.
Yeah. Thank you.
Yeah. And I think Mr. Anil is also there. 1 second, Mr. Anil. Yeah, Anil.
Yeah, I have 2 questions. Both are correlated to each other.
Yeah.
First is, when using multiple indicators, suppose I'm using Bollinger with RSI,
Okay.
and then I'm using MACD with, say, suppose some other indicator. Okay, these 2 different they are showing different trends. So which trend should I follow? That is one. And second is how to identify fake signals.
How to identify?
Sometimes the signals are, we take a call and then we realize that the signal was fake. The next signal that comes in is exactly opposite. So
okay, I will first move to your second question. Like, you had decided to take some position, and after a few minutes or after a few candles, you realize that your call was not right. So simply answer is only one, that you were not able to identify the chart. So no one is even that much expert. Even I can't that much predict that market is going into uptrend and the downtrend. Definitely we have to study and keep regular practice about that. So now we will move to first question, that how you can use, either you should use MACD or RSI with Bollinger Band. So look,
that is one side. And suppose, see what happens, I'll tell you. We attend different webinars. In our webinar, we spoke about gap, Bollinger Band and RSI together.
Yeah.
Okay, somebody else talks about RSI with say some other like MACD, for example. So, suppose I'm trying to use both the inputs from both the seminars. Okay, and the signals, what I understand, are in different directions. One says it's the end of, say, uptrend. Another one says it is the starting of the uptrend. So which one should I follow?
Look, as in my knowledge, I don't think that RSI and MACD both probably will give different direction, because those both theories are on the different platform. If you talk about the RSI, so in case of RSI, there is a patch of 30 to 70, majorly that momentum sustain in the 30 and the 70. So when market is moving towards 30, we take it as a buy call. When market, say RSI, is moving towards 70, we take it as a sell call. But if you're using MACD along with that, then definitely you will observe some kind of correlation in the RSI. So if you want to be more clear, so I would suggest to use RSI and MACD both with each other. Rather than going individual in RSI or MACD, use both all together. So definitely you may have a better idea about.
Thank you, sir. Thanks a lot.
Yeah, welcome.
Done, sir.
So anyone else? One second. I think there are no more questions. Still, if any question is there, we would be happy to help. Okay. So this was the complete somewhat analysis of the technical analysis. If still you have some queries, you can write down us. You can mail it at info@formaxmarket.com. You can make a call at 22264642 and you can also see our address 622 unit number C, 6th floor, 215 Atrium, Chakala, Andheri Road, Mumbai. So that's all for the day. Thank you so much everyone to give your presence. That's all for the day. Goodbye.